How's it going, everybody? Welcome back. June 11th, 2021. A nice, beautiful Friday here in Chicago. And this is Positive Theta Trade Management, the YouTube series where I go over trades that result in a net positive theta in our brokerage accounts. If you're new to the channel, please be sure to leave a like, comment, subscribe, and let's get right into this next video in this series. So in this episode, we will be going over vertical spreads, also known as one wing of an iron condor trade. If you caught my video last week, you know what iron condors are. I taught them pretty well. Maybe you've looked at some other videos on it. But in this one, we're going to be looking at one half of an iron condor. These are still very profitable strategies that basically allow you to trade where the stock isn't going to be. Basically allows you to say if the stock is between this range and above or this range and below, you'll be able to profit. So let's take a look at what the vertical spread has to offer us. So what is a vertical spread in options trading? A vertical spread is constructed by selling one option that is closer to the money and then going further out of the money and buying a protective option to define risk. These can also be done in the money for a more directional trade, but for simplicity in this video, we'll be talking about out of the money verticals. This can be done with both calls and puts alike. Similar to iron condors, these are usually done at strikes that are 75 to 85% out of the money. Less than 75% out of the money is a more aggressive strategy. With verticals though, I typically like doing 70%. You can go a little bit more aggressive. IV rank of greater than 40 is ideal. It brings up the probability of profit dramatically if it's above 50. So just like iron condors, these are credit spreads. These are done in high IV environments. High IV rank environments. Let's take a look at an options chain with a vertical spread that I entered recently. So here we have an options chain here with a vertical spread that I have entered. So here is the puts on this side. I am selling the 65 put and longing the 55 put. Right here is the in the money, out of the money strike. So over here we can see that the out of the money percentage this is actually pretty more aggressive. There's a 53% out of the money, and then I'm longing the 66% out of the money. So it's a bit more of an aggressive strategy. Let's see the call side vertical and see what that looks like. So over here, selling the 85 call, longing the 95 call, in the money, out of the strike here. This is a 66% out of the money call that I'm shorting. And for my protective strike, I am longing the 73% out of the money call. So how do we trade vertical spreads? Well, they're very similar to trading iron condors. After we've identified an underlying with an IV rank of over 40, we look to sell the 75 to 85% out of the money strike calls or puts and buying protection X amount of points defined by what premium we are looking for. We look to collect 1/3 the width of the strikes in premium or better. For example, if we have a 10-point wide spread, we look to collect at least $3.33 in premium. We typically sell the spread as close to 45 days until expiration as we can and managing at 21 days until expiration. At 21 days until expiration, we will either roll out our spreads to the closest 45-day till expiration option to gain more time or credit, or roll up or down to make the spread more in line with what we are looking for. Our profit target is 30 to 50% of the premium we received. If it is hit before 21 days until expiration, we close the trade and realize the profits. One more thing to note when trading verticals, if there is still high implied volatility / IV rank and the trade moves in your favor, if you still have your directional bias intact, you can move the strikes that are now further out of the money closer to the money. By rolling the out of the money spreads closer to the money, the credit you receive decreases your max loss, meaning it takes risk off of the table for you, and it brings your probability of being profitable up even more so than the original trade. Trade metrics. We are positive theta. We are positive theta when selling verticals, which means money comes into our brokerage accounts every day as long as the position is open. Short vega. We are selling options in high implied volatility / IV rank environments, and we're expecting a contraction in the implied volatility as IV has mean reverting properties and is consistently overstated when compared with realized volatility. Delta is directional. Since verticals basically establish a range for the stock to trade over / under during the option cycle, there will be directional bias to these trades, but not in the way that you might expect. For put verticals, it's more so of a neutral to bullish strategy. You are looking for the stock to trade above your break even, which is calculated by subtracting the premium received from the short strike of your vertical. Conversely, for calls, the strategy is neutral to bearish, as you're looking for the stock to trade below your break even, and the break even for calls is calculated by adding the premium to the short call strike. Again, I know that was a lot of words, and that last slide probably confused you a bit. I don't think I was explaining it super well, but I like to add visuals at the end of my videos with a live options chain. So let's hop on over to Tastyworks and see what a vertical looks like. So here we are on Tastyworks. If you're in Portfolio Kings, you have seen this trade. I opened it one day ago. It is a Sage put credit spread. I am selling the 65 put and longing the 55 put. Sage was at about $76 yesterday. Currently trading for $79.12, so I have some slight bullish deltas on it. Right now, I have 3 of these spreads, so I have about 15 Thetas on it. So about every day, about $15.65 is getting added to my brokerage account in theoretical value. So let's take a look at what this looks like on a risk profile. So here I just have one setup, selling the 65, longing the 55. I personally got 475 for opening this trade. So if you subtract 475 from $10, you get 525, which is the amount of money you need to put up to enter one spread. And then as well, you subtract 475 from your short strike, which is a short $65 put, to get us our break even of $60.25. So let me pull up the evaluate date feature on Tastyworks. So right now it is the 11th right here, 35 days until expiration. So I'm gonna evaluate at what it would look like at 21 days until expiration or on June 25th. Pretty much what we're looking at here is the P&L graph coming more and more steep as it approaches expiration. And let's look at what the P&L graph will look like at expiration, and bam, here we have it here. Right here, it is telling me that there is a 76% chance that it will be above, that Sage will be above $60.25 by the expiration of 7/16. So basically a 1-to-1 trade with more than 70% probability of profiting. If you ask me, I would take that trade any day. We're back in the options chain. Now we're going to be looking at a call vertical credit spread. So here I have Apple, and I'm going out 42 days until expiration, selling the 130 call, which is 65% out of the money. With verticals, I like to go a little bit more aggressive than 75%. But one thing to note is if you go more aggressive, there's a higher likelihood that that strike will be tested. So just something to keep in mind. So I'm over here selling the 65% out of the money call, longing the 69% out of the money call, selling the 130, longing the 131. 35 cents credit is the mid, so this is 1/3 the width of the strikes. Let's take a look at what that'll look like on the P&L graph. So currently it is trading for, as I said, 35 cents. So if we add that to the short call, which is 130, my break even is 130.35. So as long as Apple stays below 130.35 by July 23rd, I am profitable. And the probabilities of it here is 64%. Let's take a look at the evaluate date feature of Tastyworks. So right here, today is the 11th and 42 days until expiration. Let's take a look at what it would look like at 21 days until expiration. Let's go back a little bit here. So 21 days until expiration, we see that the curve is kind of decayed a little bit. Right here, along where my cursor is the theoretical, and above at the plateau is at expiration. So let's fast forward a little bit more. As it decays into the at expiration graph, you see that our P&L graph right here, our theoretical, is decaying in our favor as it approaches expiration. And then at expiration, as long as we are under 130 for Apple, we keep the full premium received, which is 35 cents in the original example. That's all I have for you guys in this video. I hope you understood a lot about verticals. It's basically a way of trading a stock, saying I want it to stay above this point or stay below this point and I'm profitable. Again, it is a positive theta trade that you can enter. That means money is coming in your brokerage account every day. Again, if you like the video, please be sure to leave a like, comment, share, and subscribe, and I will see you all in the next video.